Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we are going to learn a concept which is known as debt versus equity financing. We are going to understand advantages and disadvantages of both of them, and based on that, we'll be able to figure out, the respective choices. One can go for equity or debt. Now, over here, we are going to look at chart, and this chart is going to show you the PEP, that is a debt to equity ratio over here. So now, as you can see, this is basically Pepsi's debt to equity ratio is 2.792 closely. That is in the recent year, but it was around 0.5x in 2009 and 2010. You can see over here. It was 0.5x close to that. It has jumped and it has taken a rise over here. So it was at zero point 0.5 standing here. However, it started rising rapidly to 2.792 closely around in 2014, or basically in the current. So what does this mean for Pepsi? How did its debt equity ratio increase dramatically from zero point 0.5 to directly to 2.792? See, what is the key difference between the debt versus equity financing? How does it affect the financial strength of the company? Well, let's discuss the financing your business and what is right and why it is right, debt versus equity. So in this tutorial, we are going to discuss the same. Now, first, you need to understand at a very initial end that what exactly is the debt financing, right? See, debt means when you borrow any amount, and debt financing means borrowing money without giving away your ownership. This is very important, ownership rights. So debt finance means having to pay both your interest as well as your principal, and however, with some strict conditions and agreement, for the reason that if the debt conditions are not met, then in that scenario you fail, then there are severe consequences to fail. So usually the rate of interest and the maturity or the payback date of the borrowing is fixed and pre-discussed. So the payback of the principal can be done in full or in part as agreed upon in the loan agreement. And debt financing can be either loan, it can be in the loan form or in the form of sale of bonds. Very important, right? However, they do not change the conditions of the borrowing. The lender of the money can claim his money back as per his agreement. So hence, lending money to company is usually a safe for you, and you will definitely get your principal back along with the agreed interest about the same. So this was regarding the debt. See, debt financing can be both secure and unsecure. Financing security is usually it is a guarantee or assurance that the loan will be paid off, and this security can be a type. So whereas some lenders will lend you money on the basis of their idea, or on the basis of your goodwill, right, or your brand. And various types of security can be offered to avail a debt finance based on security, or debt finance can be available or as a different type of unsecured loan as well. Now, here we understood what is debt financing. Let's understand equity financing over here. Now, the company needs cash or additional cash to grow. So this funds can be raised either by debt or equity financing. Now that you know about the debt financing, I'll explain the equity financing. See, unlike debt financing, equity financing is basically a process of raising the funds by selling your stocks in the market, selling your stocks in the market, and the proportion of the ownership is given to the financer depending upon the amount invested in the company. So finance is required for every business, and in every stage of business, be it your startup or the growth of the company, and so on and so forth. So equity financing is another word for ownership, right? And you can say that ownership is really very important in when we talk about this. And usually companies like equity financing, because of the investor bears all the risk in the case of the business failure of the investor, is also in a loss. So however, the loss of the equity is the loss of the ownership, okay? Because equity gives you a say in the operations of the company, and mostly in the difficult times of the company, besides just the ownership rights of the investor, also get some claim for the future profit of the company. Now, satisfaction of the equity ownership comes in the form of example of some investors are happy with the ownership rights, and some are happy with the receipt of the dividends, right? Whereas some investors are happy with the appreciation of the share price. Right. Now, let's understand the advantages and disadvantages of debt financing. First, we are going to talk about the advantages. When you talk about the advantages of the debt financing, it does not give the lender the ownership and right of the company. So your bank or your lending institution, you will not have a right of telling you how to run your company, and hence, that right will be all yours. Now, once you pay back the money, your business relationship with the lender ends. So you just basically need to pay back your money. Now, the interest that you pay over here on the loan is after the deduction of the taxes. So it's always interest is always post tax. Okay. Now, fourth point, you can choose the duration of your loan. It can be either long term or short term. And if you choose a fixed rate plan, you the amount of the principal and the interest will be known, and hence you can plan your business budget accordingly. There are some disadvantage of the same. We need to understand that also very well. The first and the foremost is that you have to pay back the money in the specific amount of time, which is very important over here. Too much of loan or debt creates a cash flow problems, which creates a trouble in paying back your debts. It's called basically the debt trap. Okay. The third disadvantage is that showing too much debt creates a problem for raising equity capital, as deduct as debt is considered a very high risk potential by the investor, and this will limit your ability to raise capital. Fourth, your business can fall into really big crisis, in case of too much of debt, especially during the hard times when the sale of your organization is in the fall down, and the cost of repaying the loans is quite high. Hence, you can reduce the chances of the growth of the company. Now, if we talk about the equity, equity has advantages, like the risk is less, and you actually collect the network of the investor, which increases your prestige. You can say that an investor basically does not expect immediate returns from the investment, and hence it takes a very long-term view of your business. Fourth, you will have to distribute your profit and not pay off the loan payments. So basically, dividend will come into picture over here, and in case of the business fails, the money need not be repaid. But there are some disadvantages. Is that you can end up having paying up more returns to your than you may pay up in the bank loans. You may or may not be giving up the control of the company in terms of ownership of the share or the profit. And it is very important to take the consent or the consult your investor before taking a big for your business. And in case of huge disagreement with the investor, you might have only to take up your cash benefits and let the investor run out of the business without you. Fifth, finding the right investor for your business, it really takes time and efforts both. So it is extremely important to strike the balance between the debt and the equity ratio of the company to make sure the company makes appropriate profit. And too much of debt can lead to bankruptcy, whereas too much of equity, this is Lehman Brothers example, whereas too much of equity can weaken the existing shareholders, and this can really harm the returns. Hence, the key is the striking balance between the two in order to maintain the capital structure of the company. Well, the ideal ratio is 1 is to 2, where equity needs to be twice. Equity always needs to be the twice of the debt of the organization, and double the quantity of the equity is an assurance that the company can easily cover all the losses borne by the company efficiently. So, like we all know, it's extremely important to keep and maintain the balance in everything. The same goes with the business and investments. So, maintaining an appropriate balance between the financing your company can lead to you an appropriate profit. So, that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.